4th of December 2024 price action review. I'm going to have a look at the NQ today, and we're going to look at how price created new all-time highs today and had a 2-session up close profile. Daily chart NQ. Price took out all-time high today with this expansion candle. When we are trading at all-time highs or are trading above it recently, we can look for projections as targets, since all of this is unknown territory. So what I usually do is look for either manipulation, standard deviations, so from the high to the low that forms the swing point or turning point. That's a means of laying standard deviations higher. Or I'm going to utilize the breaker swing point to provide standard deviations for projections higher, which in this case I did. I utilized the bodies because I've noticed in my observations and studies that usually the bodies provide me more precision and often more low-hanging fruit targets, whereas if you use the wicks, they can be a little bit more overextended, so it might not always reach for it when it does go there. And usually when I use the bodies, I have like a higher probability of my level being hit, is what I personally noticed. So that's what I did here. 1.5 standard deviation, not this one because it's below the all-time high. So I look for the very next one, which was this one, 1.5 standard deviation, and I look to go to target that level as a draw on liquidity in this extremely bullish order flow on the daily chart, and weekly and monthly, of course. Okay, for our chart, I laid down a structure here for what we have been seeing for the past couple of weeks. You can see that price with the election really rapidly expanded higher, then came down, traded lower into a discount. Notice it leaving low resistance liquidity run highs behind, low resistance liquidity run signatures. So when I saw this rapid decline, I immediately thought it was likely going to be suspect in the narrative of the monthly, weekly, daily long-term bullishness that we've been seeing on the indices. So I was watching how price would react of this discount for value gap, and as seen here, it has SMT shown here, which are like that little type of confirmation I'm looking for when price is trading at a key level where I anticipate the market to potentially turn from, which in this case was this discount for value gap on the 4-hour chart. Then we could see some back and forth ranging type of price action, still slowly moving higher. Then we had another SMT here, and then the market really started its rally up higher with more larger up close candles and less down close candles inside this 4-hour small market maker bimodal fractal, small relative to the 4-hour, that is smaller. I still think these lows here are still very suspect. It's just a retail trend line. So at some point in time, which I'm not going to try to pick the top, of course, but they have to most likely come back down here and clear that out. It's just too clean, like a trend line phantom. But I'm just signing with the higher time frame order flow, so I'm not looking for it continuously looking to go short the targeted level. No, I'm just signing with the bullish order flow, looking to go long intraday, and only when it really breaks down, then this is objective. But now, then the market expand higher more recently, came back down into this for value gap, busy for value gap, institutional order for entry drill. So that's the whole sentence. Why is this a EOFET? Because you have a liquidity pool being taken out here with this busy, and then price comes back down into it. We have a overlap of a buy side liquidity pool, and which is the old high, which is a wick, which is a gap. So we have a gap overlapping with another gap, making this a balanced price range. Price could have dipped down deeper into it to hit that BPR. It didn't. It just dipped into it and then expanded higher. There's also the overlap between this up close candle on the sell side of the curve converging with how price is accumulating here inside of that up close candle. So it's like a, yeah, you could say inversed order block, or just a previous area of distribution becomes new accumulation on the buy side of the curve. Notice how the bodies stay inside of the upper half, upper quadrant really of this up close candle. That's a nice signature I'm always looking for when I'm trading a market maker buy model, in this case, for price to respect that previous area of accumulation of distribution with the bodies, which happened here. And then price expanded higher to take out the LR highs and the buy side liquidity pool of the all-time high, and then just the algorithm spools price higher towards that new highs, and hit also that standard deviation objective, which is not like a drawn liquidity, but it's just an objective I'm reaching for. Like if it takes out the high, then how far can it go? Then I usually look for inefficiency above it, but in this case, as we're trading at all-time highs, we don't have that, so I'm just looking for projection targets. Okay, 1 hour chart. I actually noticed that I forgot to outline the premium high of this new wick opening gap, but if we extend out in time, we could see that need price trade above it and come back down into it, but not reaching into it. So it could have done that, didn't. It instead rejected of this fair value gap, staying in the upper quadrant really, and then expanding higher. They have that institutional order flow entry drill. Price came back down into it, as outlined on the 4 hour chart. Very bullish, only dipping into it, and then rapidly expanding higher. Like that's a really that's a low resistance liquidity run signature when price leaves gaps unfilled, or the majority of the gap stays remains unfilled. That's like the signatures you're looking for in a bullish low resistant liquidity run. You look for the BSC to stay either completely open or partially open, as seen here. Market then expands higher, take out the all-time high overnight, comes back down into the buy side liquidity pool. We will be looking on to that on the lower time frame, since it's not enough just like read the support and resistance to just look at a old high, trade above it, come back down as now support. No, you have to look for converging PD arrays, and which we can see on the 50 minute, if I'm correct. The market then expanded higher, comes back down into, not trading down into this gap. I was considering the fact that price could have dipped down deeper into this 1 hour for value gap. It didn't. Market then expand higher and then start to accumulate, goes back down into the order block, and then really expand higher going into the close. One thing more, usually when price, again, like I said, gaps that stay open is like a low resistance liquidity run signature. Busies that stay open in this case is like indication of strong bullish order flow, as we have seen throughout this whole buy side of the curve. Like look how little up close, down close candles we have inside this whole like price action, especially once price really started to expand higher. If a smart money reversal, like in base of a larger market maker buy model, of course. Smart money reversal, low risk buy, stage 1, second stage recommendation, and then really taking off. Of course, you have smaller market maker buy model fractals here, but this is like the larger one I'm outlining here. Okay, 50-minute chart. You can see here the daily range. Power of 3. Open, low, high, close. So what do we have here? We have that level that I was outlining on the 1 hour. We have the all-time high, price trade above the all-time high, then came down back into that all high, but notice that it traded down into this bullish order block too. So we have like that converging PD array, converging of discount arrays, because once a old high gets traded above, then it becomes a discount array. So it goes from premium array as a target. Once cleared, trade above, it becomes now a discount array, like typical inversion. Just like any PD arrays are invertible. So price comes back down into that old high, which converges now with this bullish order block, and that's what you're looking for. That's what makes this high probability to go long at, not just the fact that it is an old high. No, because we have a bullish order block converging with that. So then price expand higher. Notice how the bodies stay above that old high on the daily. Only the wicks trading down into that 50-minute bullish order block. Then the market expand higher. This was all throughout London, if I'm correct, or it might just be prior to London. Price then expand higher throughout London. We're just spooling higher, not offering any significant retracement as expected in a bullish market of this kind. Especially the market then drops down. I have a divergence here, but more specifically actually here between these lows. So I outlined that on the 5-minute. We have in essence divergence here too between ES and NQ, but I would actually more focus on these ones. So we'll outline on the 5-minute. Why? Because that was during the relative regular trading hours, and this was overnight trading hours. So I'm actually more I'm going to elect to choose these one for SMT and actually just ignore these ones. So that was a little mistake here, but the market expanded higher right at the news, but notice that we left relative equal lows behind here, especially also here, but these ones are more significant. Why? Because these are this is a pre-market session low. Well, this are just London lunch lows, so these are way more significant, and I'm going to focus on that. So the market expanded higher at the news. Not looking to go long here. Why? Because we left relative equal lows behind, and we are in a premium here because we didn't. If you look at this dealing range low, dealing range high, we are in a premium here without any retracement lower. So then a run on sell side or return back into a inefficiency is expected. We have here then the market dropping rapidly lower, going into 930. So this is the 930 candle on the 50-minute chart. This is the 915 candle. So we form a swing high then at 9 AM and then break lower at 915 towards those relative equal lows. This is the GS swing for the New York session in its whole, but also the GS swing for the AM session itself. So I actually traded this GS swing since it was probable on the basis of external back to internal. Was counter trend, so I used obviously a reduced risk model, but it was a good trade. The market then reversed as anticipated, since this decline lower is just a retracement to set up new buying and then reprice higher, which is like the all-time high protocol in essence. That is in a bullish market, any retracement any decline lower is expected to be a retracement to set up new buying opportunities for smart money to distribute later on to above old highs or inefficiencies in premium. That's exactly what happened here. The market then reversed, SMT at the lows, went higher, took out that initial high, came back down, rejection block, expanded higher. Notice how the bodies just keep on trading higher, closing higher in that sense, because we have that long wick down, but the bodies still remain in the upper portion of this downclass candle, which is anticipated to be a future order block. The market then comes back down into that order block, starts to consolidate, accumulate, going into lunch. And at going into the PM session, price drops down, takes out lunch sell side, expand higher, take out lunch buy side, and then just continues to spool higher going into the close. It was just all a algorithmic spooling, which is especially good to see on the 5-minute and 1-minute chart, just a one-way street higher, and then eventually closing near the high of the day. Okay, 5-minute chart. We can see that I delineated from 7 to 4:15. So I captured here the whole New York session. We can very clearly see that price indeed ran up higher right after the news at 8:30, of 8:15 was it. Then from the swing point here, red vehicle lows, significant time-based liquidity is pre-market sell side of the whole pre-market session, but especially of precisely between 8 and 8:30. So that is that. The market then reversed, took out those red vehicle lows. Notice it does that with consecutive down close candles. If you would see this from a retail perspective, and you would just think you are the retail trader in that sense, just trying to forget everything that you know. If you would see this type of decline, you would think, oh, it's forming a top. It's going to take out lows. It's going to expand lower. That's exactly what this whole mechanic is trying to force on the retail trader's mind. That the rapid decline lower is false, obviously, as you do the swing. But if you would just think as a retail trader, you would really think this is the top and it's going to expand lower, seeing these large down close candles, especially when you go on a 5-minute chart or a 1-minute chart. You would really think that the top is in, for example. But that's of course a mechanic to engineer more buy side liquidity above, as they will go short, trying to chase that move lower, engineering more buy side, which is the perfect counterparty for smart money to distribute to. And where do they accumulate? Below old lows in a discount. So the market drops back down, take out the sell side, goes back down into this reclaimed fair value gap. Notice it initially provides support here, then the market rallies higher, then comes back down into it, and then offering support as a discount array again, and moves higher, change in a delivery, comes back down, the body staying all the way here, the wicks going back down into reclaimed fair value gap, market then expands higher towards that old high, where those buy stops are resting from traders who chase this decline going short. So they buy here and they sell here a portion, and then of course take partials out. I don't know if they do that, but of course they do. But they distribute positions here and etc. But that was like the main idea. Could see here again the news at 10 a.m. Provided that SMT between NQ and ES. There was overall quite a decoupling between the indices, meaning the NQ, the ES, and the Dow Jones. But this SMT was like more trustworthy to me because it was at a discount array that I was looking for the market to potentially turn from after it took out a significant sell side. So, and the decoupling wasn't that bad yet there, and eventually the markets all got in sync again. But in the opening range, indeed, there was a decoupling, with NQ being the strength leader to the upside. Yes, mostly consolidating, slowly moving higher, and I am just drop down lower, eventually getting a sink higher, but not instantly. The market then retraces down into this rejection block, then expand above the highs as I would like and start to consolidate. Going into lunch, notice it engineered buy side and sell side liquidity. Now, while we are bullish and are still anticipating follow up higher, I would look for a sell side liquidity rate to set up a potential market maker buy model to target then the buy side, and then very specific time based liquidity. So a typical textbook scenario is when you are looking for high prices and we have a clean lunch buy side liquidity pool and a clean lunch sell side liquidity pool. You're just waiting for the market to take out the lunch sell side while leaving that lunch buy side intact, and then you can look for a market maker buy model on a lower time frame or just a 5 minute, and then targeting that lunch buy side liquidity, which will form the original consolidation on a lower time frame. So I was tapering that I don't trade as the NFP protocol says after the pre-market session on Wednesday. So it was very insightful to see that play out, that scenario that I had in mind. Notice the body staying above the bullish order block on the 50-minute chart and reaching down at that bullish order block open on the 1 hour. The market then reverses. This is like the beautiful signature you're looking for. The body's respecting that, staying above the old low, and only the wicks trading down into it, giving that clear indication that this is indeed manipulation to run sell stops and that the drawn liquidity is higher. The market then expanded higher, came back down into this inversion fair value gap. Usually the first inversion for value gap, or rather the last fair value gap prior to the turn is high probability inversion fair value gap in terms of market maker models. The last in terms of a market maker buy model, I would say the last SIBI prior to the smart money reversal becomes a high probability inversion fair value gap on the buy side of the curve, which often form the low risk buy or just a retracement that's going to be minor at the SMR. So I recently discovered that also through a teaching of IST, which was actually a very good lecture. It was a very long one, but it was really good. And putting it to context of market maker models, I found it very insightful. So the market came back down at this order block, then really started expansion higher above the lunch buy side, reaching for that 1.5 standard deviation on the daily chart, and then it was just a whole algorithmic spooling higher, barely any retracements, no retracements actually on the 5-minute chart of significance, and just kept on going higher. Where could you then reach for, say you bought here at inversion fair value gap, or just the fair value gap in general here, you bought here, or you bought as a turtle soup here below this old low, then you could look for a standard deviation projections higher, which I would like to use this very obvious breaker standard deviation. So you have the low prior to the stop hunt and the high prior to the manipulation lower. So candle 1 and 2, A and B, and you can then look for projections higher, and in this case the 2 standard deviation overlaps perfectly with the bodies here, and the actual high of the day in terms of bodies formed right at that -2 standard deviation, using that breaker swing point, which was like very, very cool to see that unfold live in real time. I was watching this whole algorithmic spooling, and it was just so interesting how the market just kept on running higher, and every short really got punished. Like you saw minor declines lower, so you would think, oh, people are going short here, and they just get immediately punished with a rapid expansion higher. Also the difference on lower time frame, how those down close candles were like very slow in terms of delivery and very small relative to the up close candles. And then when the up close candles followed up, it was just bam, it was rapid move higher, magnitude, energy, etc. It was just very cool to see. And then to see that delivered literally to the tick in terms of bodies to that standard deviation was very cool. So overall, it was a very insightful day.